Good morning, everyone, and welcome to the 89th episode of the Veritas Fact-Finding Series. And this morning, I'm joined by Professor George Athanassakos. Good morning, Professor.
Good morning.
Surfacing facts and revealing truths is a never-ending quest for us at Veritas. In each episode of our fact-finding series, we go on the ground to speak to industry professionals in an unscripted, candid video format to discover how we can make better investment decisions. In this series, and with everything we do, we believe the facts empower investors and that better information leads to better investment decisions. By way of background, my name is Scilipoti, and I'm the president and CEO of Veritas, which is an independent equity research firm based in Toronto, Canada. And I'm proud to say we celebrated over 20 years being 100% employee-owned and operated. I have a quick note to disclaimer. This broadcast is not to be taken as investment advice, and participants or employees of Veritas's group of companies may own securities discussed in this broadcast. While we love all our guests and Professor Athanassakos in particular, this session may contain forward-looking statements, investment opinions, and comments that we do not agree with at all. Now, for those of you that don't know Professor Athanassakos, I'm going to give you a very quick background. And we had him on in December of 2020, giving us a lecture in preview to his recently published book. And if you don't have a copy yet, and I know, look, our bent is value investing. This is a must-have. Value investing from theory to practice, a guide to value investing process. And we'll definitely make available, when we put out this video, we'll make available the link to that previous presentation. So Professor Athanassakos, he's a professor of finance at the Ben Graham and the Ben Graham Chair of Value Investing at the Ivy Business School, which he joined in 2004. He's also a founder and managing director of the Ben Graham Center for Value Investing, which he launched in 2006. And the founder and managing director of the Center for the Advancement of Value Investing Education, which he launched in 2008. Prior to joining Ivy, and this is particularly interesting if you listen to our previous discussion and maybe where he got all his value investing concepts, and it's very endearing to me because I learned to be a value conscious individual from my dad and my family, who was Italian. Of course, George grew up in Greece, and he actually did his first undergrad and his master's in economics in the School of Industrial Studies in Thessalonikas in Greece. And then he did his master's and MBA and PhD in finance at York University. He has a number of different fellowships in financial planning, and as well, this one in particular stood out, Quality Shareholder Initiative, the law school of George Washington University in Washington, D.C., and he's the only Canadian to receive this designation. Frequent media commentator. If you're not following his articles in the Globe, you definitely should. They're very interesting. And today, what we're going to do to kick things off is we're going to discuss modern portfolio theory versus value investing from a risk and investment standpoint. And then after the prepared presentation, we're going to open it up to questions from the group, and we have some as well. So with that, I'll turn it over to you.
Thank you very much, Anthony. Let me share my screen. Okay?
Perfect.
Good. Okay, good morning. As you heard, my name is George Athanassakos, and I'd like to welcome you to this event, and thank you very much for joining us. As you heard, I hold the Ben Graham Chair in Value Investing. The chair was endowed by Mr. Prem Watsa of Fairfax Financial, and my mandate was to develop an academic program in value investing and spread the word of value investing to academics and the public, because academics don't know much about value investing, and the public is somewhat confused about what value investing is all about. So over the last 17 years now, I developed the Ben Graham Center for Value Investing and a rigorous academic program in value investing at Ivy. In addition to developing value investing courses and carrying out research on value investing themes, we're also offering apprenticeship to our students through our Ivy Value Fund. The Ivy Value Fund is a fund investing in student recommendations, those who take my course, and it's managed by recent graduates. And you can go to the Ben Graham website and sign up if you want to receive our quarterly reports and to see what stocks we own, what we buy, what we sell. In addition, we offer seminars. Okay, we offer seminars. This is a 5-day seminar we offer in the summer. This year is May 30th to June 3rd. It's a 5-day seminar. I basically teach this, and it's live. I decided to do it live. I think value investing can be learned better through live on-hands training. And it's open to professionals, but also individual investors who have an interest in value investing. And Jeff Stacy will be a keynote speaker at this seminar. So that's a seminar that I teach. And then in April, we have a conference that I coordinate and I MC. And this is on April the 20th. And this will be virtual. And we have three keynote speakers. The morning keynote speaker is Russell Napier. We'll talk about more macroeconomic events. And Raj Subramaniam is the CEO of FedEx. We'll talk about FedEx. And then Bob Seaman will talk about Bitcoin. And then we've got 5 very well-known, high-profile value investors who will talk about how they put theory into practice in their own profession from a global perspective. And so, you know, the registrations are still open. We'll close, I think, in a couple of weeks. So please register as soon as you can if you want to attend. Also, as part of my activities in the center, as Anthony mentioned, I recently published a book, a value investing book, From Theory to Practice. This is the first academic value investing book. Most of the other value investing books out there are more like descriptive trade books. This is an academic book. And the foreword is it's a 400-page book. Okay, so I cover a lot of topics, and we'll have a chance to talk about this later. And the foreword is written by Prem Watsa. So, with this program that we have here, we're making history, as we're the first university in Canada. We have developed a fully fledged academic program in value investing, and the second in the world, after Columbia, where Ben Graham, the father of value investing, taught. At the same time, we're breaking new academic ground as we're taking a trade subject like value investing, and we have elevated it into a rigorous academic topic. In other words, we brought value investing and stock picking to academia. And this is big because academics have paid little attention to stock picking and value investing over the years, and particularly with regards to the value investing view of risk and risk management. So today I'd like to discuss and contrast risk management under model portfolio theory versus risk management under value investing. And I want to set the record straight. I talk about this more extensively in my book. So here it goes. Modern portfolio theory. This is what is taught at universities around the world. This was taught by academics. And the 2 key tenets taught at every university, and everyone who has a finance degree has been taught about this, is that investors, rational investors, hold well-diversified portfolios. And that in this setting, the only risk that matters is beta risk, that is volatility-based risk. Now, how did academics came up with this idea? Well, academics define total risk as having 2 components. One is systematic risk, and the other is unsystematic risk. Systematic risk is the risk that comes from the system, affects all companies. Unsystematic risk is risk specific to a company. Okay, the death of an executive, the launch of a new product, and so on. And then academics, because they like always to put formulas, they quantify these risks. And they say total risk is quantified by the variance of stock returns. Systematic risk is quantified as a function of the beta of the stock. And the unsystematic risk is some kind of a residual volatility. And then they say, but you know, the rational investors will not hold a single stock. Instead, they will hold, based on the theory, a well-diversified portfolio. So what they care about, they said, is not the variance of the stock, they care about the variance of the portfolio. And so they care about the systematic risk of the portfolio, which is a function of the beta of the portfolio, and the unsystematic risk of the portfolio. Now, it turns out that the unsystematic risk of the portfolio approaches zero. That is, when you put together many stocks, some stocks have positive events, some negative. When you put them all together, the risk disappears, this residual risk. So the risk of the portfolio is a function of the risk of the beta of the portfolio. Now, if we take now a new stock, A, and we add to this portfolio, the unsystematic risk of this stock will evaporate when it's mixed with the other unsystematic risk. And the only risk addition of this stock to the portfolio will be the stock's beta. And this gave rise to the CAPM, which says that the expected return of the stock is a function of the beta. The markets will not reward you for unsystematic risk because unsystematic risk can be diversified. They will reward you only for beta risk. So they say, you guys who are value investors who try to pick stocks, the only thing you achieve is you achieve a non-well-diversified portfolio, which will expose you to a lot of unsystematic risk, for which the markets will never compensate you because it will only compensate you for beta risk. So you end up with a lot of unsystematic risk and high probability of high losses. And they say diversification will protect you against losses. Now, as value investors, actually, we reject both of these tenets. We don't believe that astute investors must hold well-diversified portfolios. And we reject the notion that beta is a measure of risk. You know, the problem that we have with modern portfolio theory is that modern portfolio theory, so do we need that well-diversified portfolios? We say no. Our problem with modern portfolio theory is that it regards diversification as a substitute for due diligence. Okay, they say, don't worry about understanding stocks, don't worry about understanding management, don't worry about understanding the markets, the economy, not the economy, the industry and the competitive situation. Diversify, and diversification will save us. So they say a stock-by-stock analysis is a wasted effort. Diversify and diversification will save us, and you don't need to know anything about the stocks. But of course, you know, if you look back in 2008 and 2020, diversification did not help you. In fact, diversification fails when you most need it. But even if we accept that diversification reduces risk, its downside is that also caps the upside. You know, economic theory, in fact, economic theory suggests that a perfectly diversified portfolio in the long run will earn the risk-free rate. Okay, so you want to perfectly diversify, you're going to get the risk-free rate. So why not buy a government bond and cut to the chase. Actually, this very important notion is behind the Black and Scholes model. I don't know if you ever saw the Black and Scholes model.
Sure.
And if you saw it, many people wonder, why the RF is a discount rate? Well, because of this. So if you take a finance course in a modern portfolio theory course, they will show you some charts and they say, if you find two stocks or two assets that are perfectly negatively correlated, and you combine these assets in a portfolio, there is a combination that has no risk, basically, sigma equal to 0. And so they say its expected return must be the risk-free rate. So they show this in modern portfolio theory charts. Now, in the real life, it's very difficult to find, or it's impossible to find, two stocks or two assets that are perfectly negatively correlated. But you can find two assets that are perfectly positively correlated.
Mm-hmm.
A call option and the underlying stock are perfectly positively correlated. So how do we make them negatively correlated, Black and Scholes said? If we short one and buy the other. So the Black and Scholes devise a strategy where they short a call and buy M number of stocks. The M tells you the proportions to make this portfolio risk-free. And then they say, if this portfolio is risk-free, it's expected there must be the RF. That's why, if you see in the Black and Scholes, they've got the risk-free as a discount rate, because that's the idea of perfectly diversified hedge portfolio. Now, back to diversification. I have some quotes here from famous people. Third Avenues, a big value firm in New York. Mm-hmm. The late Chairman, Martin Whitman, he said in one of his reports, he says, in a very important sense, recommending diversification is a bad advice. It may, and then Buffett says, diversification is protection against ignorance. It makes little sense if you know what you're doing. And this echoes actually John Maynard Keynes, who had said that once you achieve competency, diversification is undesirable. And finally, recently I saw an interview by Charlie Munger, and he says, if investors hold a portfolio with 100 stocks, they think they invest more professionally than if they hold a portfolio with only 4 to 5 stocks. This is insanity, total insanity. But beyond this, beyond this discussion, even if diversification could work and would work if we could measure all possible risks. But we don't. There are two kinds of risks. Okay, there are two kinds of risks. The risk we know we don't know, and this is measured by the variance of returns. And then there's the risk we don't know. This is not measured or captured by the variance of returns. Diversification does not protect you against the risk you don't know, also known as fat tails. French mathematician Benoit Mandelbrot wrote a book with the former editor of the Wall Street Journal, Richard Hudson. And in there, they plot the daily returns of Dow Jones over the last 100 years. And they plot them on a graph paper. They show that this line does not look like, the distribution of these returns does not look like a bell curve. The far edges flare too high. This is what they refer to as fat tails. Now, the first academic to discuss this actually was Keynes, John Maynard Keynes. But what he was talking about, his views did not prevail, because it was very difficult to quantify and capture what he was saying in mathematical models and formulas. And what prevailed was the views of mathematician Thomas Bayes, who gave rise to Bayesian statistics, who said, no, we can measure this. It's like putting bets on a roulette. But in the roulette, we know what we don't know, okay? We know all the odds, even though we don't know what the number is going to come up. So if you want to plot against the possible outcomes of a roulette, look like bell curve where the distribution ends touch the horizontal axis, a bell curve. Real life is not like this, okay? Real life is not like this. And if this is not what real life looks like this, all the models we have in finance and all at university, like Black-Scholes, value at risk, market efficiency, and so on, will not work. Because the markets are not like a roulette. Markets are not like a game of roulette. Remember, in roulette, the odds are fixed, and what we observe around us does not affect the odds.
Mm-hmm.
Okay, so in real life, risk is not like a game of roulette. Okay, the return distribution does not touch the horizontal axis. It does not look like a bell curve. Our world looks more like a poker game, where what we observe around us affects the odds. And if this is how it is, then all these models will fail, as they have failed in the past. So another quote, I want to read a quote from an article which has not found its way into textbooks yet. It says, quantifying risk in financial markets is far more fraught than estimating the likelihood of fire, burglary, death, roulette. And here's the punchline. Financial markets are not natural phenomena. They are man-made, made by men and women whose business is gauging into an uncertain, risky future. The art of managing risk in such an environment alters the environment, creating an unstable feedback loop. And if this is how it is, then it is not possible to develop formulas and closed-form solutions. And models that based on the bell curve will fail. Most of these models, they use history. Okay, they use history to observe, I guess, the distribution of possible outcomes. And so they don't take into account, outlier events. So arbitrage models based on historical relationships, not counting for outlier events, and using leverage are reckless and will fail. You know what happened to long-term capital management back in the late 90s? The firm was established by 3 Nobel Prize winners. So they used the past to develop a relationship between bonds and stocks. And they said, we're confident that we know what we don't know. And they bet 100-1 to this. And then the don't know happened. What happened was Russia defaulted on its debt. And all the relationships changed from historical. And they went bankrupt. And the Fed, of course, saved them because it was a risk of the whole financial system will break down. Does this sound familiar? Russia may again default on its debt. Mm-hmm. Okay, may again default on its debt. And this may kick shock waves throughout the system, especially if we discover that some institutions are up to their neck in exposure to Russia, more than what we thought originally. Now, if I have here some numbers here. So Russia, there is 80 billion US 80 billion due the next 12 months. Of that, 21 billion is dollar denominated, held by non-residents. Who are these guys? Who are the non-residents? How much are they exposed to it? Do we know it? Are they exposed more than what we thought? So these are now outlier events. And if you didn't have it in your thinking outlier events, and you hedged and you formed these arbitrage models and took a lot of leverage, then you may run into trouble. So I want to reiterate here that what many math-oriented academics miss is that finance is not a natural phenomenon like physics. It's man-made by humans with an effort to manage risk, affect risk. And human behavior is difficult, if not impossible, to model. You know, I mean, I'm surprised actually, because I see many times companies advertise for finance positions and they require a PhD in math. And you say, what's going on? Why you don't ask for someone in finance? And they say, well, you know, we can teach the math guy finance, but we cannot teach the finance guy math. And then you take this very hugely intelligent people, you put them in a room and you say, don't get out and you develop this model. These people have no global understanding of market situation. And then they form these models that work sometimes, but when you got these outlier events, don't work. And recently I was happy to see an article by a super quant guy, Andrew Law in MIT, wrote an article which titled Warning, Physics Envy may be hazardous to your wealth, in which he argues that physics envy has created a false sense of mathematical precision. But you know, academics, they like to put everything into mathematical formulas because they don't understand, I guess, the businesses. So they try to say, don't worry about understanding businesses, just diversify. So, I mean, what do we want? Okay, so I said what we don't want. What do we want? Well, first of all, we want to reduce risk without limiting the upside. So how do we handle risk? Well, we believe in due diligence. Okay, we select securities after in-depth due diligence. We want to understand the company, the business, the management, the competitive situation. We invest in companies with a long history. Okay, normally we don't invest in startups. We want long history so that we understand, I guess, the business risk, the financial risk, the management performance. We never buy on margin. And we never buy and we avoid over-leveraged companies. We employ position limits. We don't allow a stock to dominate the portfolio. Remember what happened in early 2000 when Nortel went bankrupt. Nortel was like I don't know, 60% of the index. So all those who had 60% in the portfolio of Nortel had real difficulty. We have checklists. Checklists are good to have when the risk is high. That's why airline pilots have checklists. So we have checklists, why I want to buy. Okay, why I want to buy, and what actually am I buying? And we have a disciplined approach, when to buy, when to sell. And we never short, among other risk mitigating strategies, but more importantly, we employ the concept of margin of safety. That is, we only buy a stock if its price is well below the intrinsic value. That is, at the time of Ben Graham, the margin of safety was 50%. So he would say, I will buy $1 for 50 cents. And nowadays, more like a quarter, 1/3. So if the stock is worth 10, I will not buy until the stock hits 6.66. But let me be clear, okay? We don't totally reject diversification because if we did, we'll buy only one stock. We don't do this, but we have a concentrated portfolio, maybe 15 to 30 stocks. We believe that some diversification along with the margin of safety can deal with the risk discussed above. So the diversification protects you in the risk you don't know, and the margin of safety against the risk you don't know. Put them together, and you got a better risk management practice. Nassim Taleb, I'm sure you heard the name, is the author of Black Swan. So Nassim Taleb co-authored an article which was published in the Harvard Business Review, and they talk about the 6 mistakes executives make in risk management. Mm-hmm. 2 of the problems they identified were, first, that they study the past, and second, they put faith in the variance of returns. And they conclude the article by stating that risk managers place a greater emphasis on making money than avoiding losses. Okay, they place more emphasis on making money than avoiding losses. For value investors, avoiding losses is the key. Value investors would rather minimize risk than maximize returns. Okay, we prefer to minimize risk than maximize returns. We adhere to something that many years ago Aristotle said, which was the aim of the wise, okay, the aim of the wise is not to secure pleasure, but to avoid pain. If in your life you avoid pain, you are ahead of the game. If in investing you avoid losses, you are ahead of the game. Rule number 1, avoid losses. This is the role of margin of safety. And I was actually very happy to see, I saw recently, I have here an article would talk about trends, developing trends. And he said, another management trend is that maximizing returns would no longer be managers' sole investment objective. Well, I mean, who always know about this? Okay, so people start to come around in a way of thinking. I remember also we had many years ago a legendary value investor, Walter Schloss. I talked to my students, and one of the students asked him, what's the most important thing in investing? And he said, don't lose money. Because if you lose money, it's very difficult to recover. If you go down by 50%, you've got to go up by 100% to break even. Valuation deals with the future in a world of uncertainty. A lot of things can happen that only you don't know, but you don't know. But when you take 1/3 of the intrinsic value before you buy, you've taken away a lot of things you don't know. Okay, so the role of margin of safety is to protect the downside. How about risk? Is beta a measure of risk? We reject this notion. Okay, we don't think beta is a measure of risk. Risk is not volatility. Volatility is good. Risk is the possibility of permanent loss of capital. Mm-hmm. Okay, and Howard Marks have said this many times that we can ride out volatility, but will not be able to get the chance to recover from a permanent loss of capital. We cannot undo a permanent loss of capital. And when do we have a permanent loss of capital? If you invest in an over-leveraged company, which may go bankrupt during a recession, then you get permanent loss of capital. Or if you invest on margin, you may be forced to sell, even though you don't want to do this, and then you have also a permanent loss of capital. You know, even the father of popularizing beta, Eugene Fama, from the University of Chicago, in a recent paper, he referred to beta as garbage. Now, will investors, value investors' view of risk will change the view, I guess, of academics about risk? I don't think so. I don't think academics are too invested in the status quo to let a few value investors or a few aging academics, argue against modern portfolio theory. But next time that you hear about you must diversify and that beta is a measure of risk, ask why billionaire investors like Warren Buffett, Charlie Munger, Seth Klarman have mocked these concepts and whatever is taught at universities around the world. A couple of things that just I want to close this with a couple of things. I always thought that portfolio managers underperform not because they lack stock picking abilities, but rather because institutional factors force them to over-diversify. Most of them know what the right thing to do is, but because they have short-term perspective, what they care about more than doing the right thing is to save their jobs or save assets under management. So because of that, they tend to over-diversify. Okay, that's the safest thing for them to do is buy an index. That's why we see many mutual funds are closed indexes. So, consistent with my view, I guess, of this, my advice, I guess, to institutional investors is to develop their own teams of analysts and stock pickers. I know this may be difficult for small funds, but for larger funds, it may be desirable, and this will save them, I guess, will have the benefits of stock picking, and then save them a lot of investment management fees. And I want to remind you again, this thing that, because of the fear of losing their jobs or asset management, they tend to over-diversify. And they think that by over-diversifying, it makes them more professionally behaving and safeguarding the client's money. And I want to repeat again what Charlie Munger said. Investors believe that if they hold a portfolio with 100 stocks, they invest more professionally than they hold a portfolio with 4 to 5 stocks. That's insanity. Maybe, most of these people went through a finance program which said, diversification will save you, diversify. I mean, how can you know if you had 100 stocks, 200 stocks, how do you know in depth each one of these stocks? And recently, I don't know if you showed it, there was a study that Bloomberg did. And they report in the study that portfolio managers with a CFA underperform those without the CFA. Because the CFA is totally modern portfolio theory. Okay, it's been kidnapped, I guess, by the academics. My advice then to professionals, especially those starting their careers, never start your analysis with spreadsheets and formulas, because this shows you don't understand what's happening and you're trying to hide behind the formulas. Start with a qualitative analysis. Demonstrate you understand the company, the business, the management, the industry, the competitive situation. Remember, the math can be good, but if you understand if you don't understand the business, you're not going to do well. So once you get the qualitative stuff out of the way, then put the formulas and the spreadsheets, not the other way around. Here's another quote. The derivatives business and other financial sectors on the rise in recent decades have been dominated by young ones who are very good in working statistical models, but they lack the market experience needed to make informed judgments. Okay, this quote refers to the so-called rocket scientists and their computer models who use the past to forecast the future and do this with unjustified assurance. And so they develop risk-proof models that fail the real-life test when they're most needed. And as Buffett says, beware of geeks bearing formulas. And again, I want to refer you back to the long-term capital management. Super rocket scientists, but they were so unjustifiably sure that the past would repeat and that the bell curve represented risk in the financial markets, and they levered this 100-to-1 and they went bankrupt. According to value investor Avner Mandelman, he says to deal with financial numbers, simple arithmetic is enough. Complex math is not necessary. And he concludes by saying, in other words, the essence of business, the conflict, the personalities, the drama cannot be encapsulated in language, let alone in math. You cannot really model human nature. I mean, we're all have some common factors, but every human is different. Same with a company. Every company is different. That's why I don't think AI and machine learning will replace stock pickers. They may make their life easier or more efficient, but they cannot replace them because computers cannot read between the lines. Okay, they cannot read between the lines. The world is not linear. That the regime changes, and if the regime changes, as I think are happening now, these models will fail. Okay, so with this thing, I want to thank you, and I'll stop here, and I'm ready to answer any questions you may have.
You can just stop sharing your screen.
Okay,
and if anyone has a question, if you just hover over the bottom of your screen there, you'll be able to type in a question. Now, let me just, perfect. So I have a couple of questions for you, Professor. Let's get going here. Let's start out with the new book. You just wrote your new Value Investing from Theory to Practice. What was the main reason you wrote this book?
Yeah, there are two reasons. The first one is for academics, and the second one is for professionals. So there are only two academic programs in the world in value investing. One is the Columbia, and one is here at Ivy. Why are there only two schools? Well, there are two schools because academics are not taught about value investing. They have no clue about what value investing is. In fact, they think we're like witchcraft doctors. And so young academics who come to the university, they don't know what value investing is. So they're very adverse, I guess, in dealing anything with value investing. And most of the young people, they want to have something to hold their hand. There's no book academic on value investing. So I think having a book, an academic book in value investing, would be like a stepping stone that universities may be encouraged to start offering value investing courses. And of course, the other is I want to help also practitioners go into more depth to the theory of value investing and the practice, because most of the books out there are very descriptive and have similar rules. So I want people to understand more in depth. And I want value investing eventually to get the legitimacy that it's worth having.
And it's interesting, you know, I guess the problem with the whole concept of value investing is that since the financial crisis, the markets have generally just gone up. with a few blips in between, but generally just gone up, and fueled by low interest rates. And we talked about this extensively in our last presentation about when value investing will actually work and what makes it work and what doesn't make it work. And that was a great presentation and discussion that you had. And it would seem that right now may actually be a time as rates start to turn where stock picking may become again in vogue. And so maybe this could be a time when people need to refresh, because there's been so much lack of training and attention being paid to this style of investing, that maybe it comes back.
Yeah, definitely. I mean, I looked actually in one of my studies. Let's see. I looked at periods of high inflation and low inflation.
Yep.
And the 3 decades, if you look back 100 years, the 3 decades with the highest inflation were 40 to 50, 70 to 80, 80 to 90. Okay, the median value, the median outperformance, value versus growth. Okay, the value premium, so the difference between value minus growth, the returns, in these 3 decades were 7.5, 10, and 14%. That is, in these 3 decades of high inflation, value beat growth in the first one by about 8, in the second about 10, in the third by about 14. The 3 decades with the lowest inflation was 30 to 40, 50 to 60, 10 to 20. In these 3 decades, the value premium was negative 2.1, 2, and negative 2.7. So periods of high inflation are beneficial to value investing. And I think we're in a period where we may have a regime change. That is, as you mentioned, the last 40 years were years where the market was going up because the underlying forces were supportive to market going up. You have low real interest, low inflation, you have globalization, and all these benefits, particularly the growth companies. But now I think we have a regime change. I think from now on, we start seeing real rates going up, inflation being higher, and deglobalization. All this will affect stocks, particularly the growth stocks, who are the biggest beneficial of globalization. So I'm really, and I don't think the markets have discounted this, okay? So I don't know what is going to happen when the markets realize that there's a regime change.
Yep, and we're seeing it. And now what differentiates this book from the previous book that you wrote?
Yeah, the previous one was more academic. This one is more is on a value investing take. So what is unique? Many unique things, okay? One uniqueness is that the book is not only about finance. The book has accounting, finance, strategy, economics, and psychology. Okay, so like the book's like a mini business degree and show you how you can put all this things together in a concise and logical fashion. I don't think this has ever been done before. Why? Because finance people don't understand accounting, strategy people don't understand finance, and they cannot really put them all together. Everybody deals with their own, pillar. So that's one, I think, innovation. The other is that I wanted really very badly to show that what we do as value investors is consistent with academic valuation. So I start with the academic valuation, the traditional models, and I show them in the book how this model can converge or transition into what we do as value investors. And that's very important. And I'll show you also how value is created and how value creation is consistent both with value investing and traditional in a very, very consistent way. Also, I show something else which is very important, that value investors do not really reject growth stocks. That's not true. Value investors actually value growth stocks. The only thing is they don't want to pay too much for them, okay? Yeah. As most people would like to do. So, and then I have also a website linked to the book, and the website has a model that we can use to practice. And in addition to the model, I've got also application, show how the model is used in real life, real-time valuations. And finally, I show people how accounting and tax changes have affected valuation over the years. And I go over different tax regimes. I say, look how these tax regimes and accounting regimes have affected valuation.
Now you just touched my heart, because that's obviously all the time that we spend looking through the financials and spending time going through the accounting. And I love I made so many notes. I hope those listening did as well. But I love the point that you made, that you can't model human behavior, and because you think that we're going to act the same way every time we're faced with the same situation, but the reality is we don't. In a group, we might, but as individuals, we don't, and it's very difficult to model. And it's great. I give the example many times, talking about it's more about learning to play poker than it is learning to play roulette. And a couple of good questions here from the crowd. I want to make sure we get to these. So thanks, Frank, for throwing in here. About discount rates in this environment. On the cusp of potentially meaningful higher rates, do value investors think of discount rates cyclically or set a constant standard?
Well, that's a good question, actually, because academics, they rely on formulas, okay? They calculate the beta, and based on the beta, you calculate expected return. But the beta, in theory, may be good, but in practice, it doesn't work, because it's very difficult to really get a sense of what actually beta is. And I've seen many surveys of academics who all agree that when you forecast the cash flows have to reflect the company, the industry, the economy, and then with some, I guess, intuition. And then for the discount rate, they use a formula. And you say, why you don't use an intuitive way to calculate the discount rate? And they say, well, we don't know. We know the beta, and that's all we're going to use. So in the book, I show an intuitive way to calculate the cost of capital. Always, so it's a step approach. Always start with understanding the company's business risk. Okay, riskier businesses will have a higher discount rate. Then, after business risk, understand the company's financial risk, exposure to debt. Okay, two companies in the same industry with the same business risk have different discount rate because they've got different financial risk. So I start, I guess, so my starting point is the risk-free rate. And then on top of this, I put a premium for the financial risk. And on top of this, I put a premium for exposure for the equity exposure. I have to assume. So why do I take the risk-free rate? And I'm taking the long term, like 10-year government bond. Why I'm taking the long-term rate? Well, I'm taking the long-term rate because I think that's the consensus of the markets. And I know in general, bond investors have done better have better ability, are smarter, I think, than equity investors. Mm-hmm. So I have to take, I guess, what the consensus in the market is. Now, they may be wrong, but so I start with the RF, I add a premium for financial risk and a premium, I guess, for the equity risk. Now you say, and I mean, I've done this for many years, and people are saying to me, but you get like a low discount rate and high values. Well, this is what we'll be getting, okay? We're getting high values because the rates are low. If you don't believe, I guess, that rates are going to be low going forward, or be like more than what the bond market forecasts, I say, hedge, use long-term puts to hedge your position. So I don't try to forecast anything. I use what the bond holders tell me they want, and bond holders incorporate, or they invest for 10 years, they incorporate what the inflation will be on average, what the real rate will be on average. So right now, I think eventually the interest rate will be normalized, okay, to higher. I mean, there's no way, like inflation, no way inflation is going to be 2%. Okay, inflation probably will be 3% or better. So in this environment, the RF should have been like 4 to 5%. Instead, it's only 2.5 or something like this. Now, but again, I think the bond investors have been right the last 40 years. So I don't want to bet against them. So I'm going to use what they're telling me. If they feel comfortable with 2% inflation and 2% real, I don't know. I'll take what they say. But then I'm going to incorporate my own view of the business and financial risk of the company. And then, so I did some risk adjustment. I find the intrinsic value, and then I'm taking 1/3 off. So because I don't know what's going to happen, maybe rates will be higher, okay? So I'm taking 1/3 cut to take into account things I don't really know what's going to happen. So I account for risk twice. One is by using higher discount rates based on the business and financials of the company. And second, I take 1/3 off for this I don't know. I mean, I didn't know that Russia is going to invade Ukraine and what effect this may have on the financial markets. But when I take 1/3 off, so there are two kinds of things that I adjust for. Okay.
Good answer and good question. I'm going to combine a question here we got from Scott. Thanks, Scott. And if I look here at stock markets right now, right, they've risen in the past during interest rate cycles. So why should we be worried now about interest rates?
Yeah, I did another study on this actually. So between 1950 and now, there were 12 Fed tightening cycles. Okay, out of the 12 cycles, 11 had positive return and 1 had negative return. Overall, I guess over this, there were about 10, I think, so about 12 cycles. The average stock market return over these 12 cycles was about 9%. So why worry? Why worry about interest rates if the market has gone up over this period? Well, I don't worry about. I mean, for me, I guess gradually rising interest rates is not going to be a problem, as long as the yield curve remains positively sloped. If you look historical cycles, most people say, these cycles were about 2 to 3 years, 2 to 4 years in length. And they look at that 2 to 4 years and say, over this 4-year period, the average return was positive. But then they don't look within, because always the devil is in the details. If you look at this cycle and you say that despite the rising rates, the market went up. But if you look in these periods, there were negative actually market returns, and this coincided with negatively sloped yield curves. So I don't worry about the rising interest rates as long as the yield curve is positively sloped. Unfortunately, it's getting very close to being negative. So in 2020, the difference between the 10-year bonds, government bonds, and the 2-year was about 160 basis points. In February, it was about 60 points. Now it's about 30 points. And with the Fed being aggressive in tightening, I wouldn't be surprised to see by the end of the year, negatively sloped curve would be negative for the stock market. So I'm not afraid about the rising interest rates. I'm afraid about negatively sloped yield curve. Because negatively sloped yield curve shows something about expectation about growth. Okay, and negatively sloped yield curve forecasts slowdown, even a recession. And this will hurt particularly the growth stocks.
And we've already seen that come to pass, especially in the last sort of 6-7 months.
Yeah, as the yield curve becoming flatter and flatter and flatter,
yeah,
it's getting more and more
the present value of those cash flows is lower and lower.
Yeah.
Because right now there are no cash flows in some of those growth names.
Yeah,
so
I mean, we know to start with that investors tend to always overvalue growth, they overpay for growth.
Yes.
And we see now, I mean, if you look at the growth stock, like many of them, like are down 50%, 60%, like Peloton is down like 70%, Netflix. It's just amazing, you know, how much people overpaid for these stocks.
Yeah. Let's maybe wrap it up with something that I think is really relevant to where we are right now. And investing during wars, it's shown historically to be profitable as indices have been up more than down. So what should value investors be thinking about and doing right now?
So, I mean, yes, it is true. It is true that if you look at wars, and I have not really done a lot of research in this area, but I looked at the wars and stock markets from the Second World War onwards. So like the Iraq War, the Afghani War, Kosovo, Persian Gulf War, Vietnam, Korean War. Now, overall, over this, 10 different events, it was positive return for the stock market. I think, and again, I have not done the research, and I'm looking actually at this right now, trying to figure out what happens here. I think if war coincides with higher real rates, higher inflation, and deglobalization, that would be negative, I think, for the stock markets. And I think also when people talk about generalities, and like I said before, always the devil is in the detail. Okay, the question is, yes, the market went up during the wars, but what was the composition of the indexes at the time? Because right now the composition is dominated by growth stocks. What will happen to the growth stocks in an environment of deglobalization? I mean, we've seen that actually, if you look deglobalization starting actually after 08. After 08, companies slowly start to get out of globalized trading. This worsened during the pandemic, and now with the invasion of Ukraine, that was like a death nail on globalization. And deglobalization will hurt primarily growth stocks because they depend on growth, on trade a lot. So I think you may see this time to be different because the mix of the index is much different than it was before in the previous wars.
Again, it's all about that fat tail, and where what we don't know, we don't know.
What we don't know, we don't know. Yeah.
So with that, look, I want to thank you, Professor. Is there any other? I want to launch our poll and see if we can make this work. Just hit the poll button there. Oh, okay, so it was up. Okay, good. Just hit end. That's fine. Good. And so if people could just answer the poll and tell us what a great job you've done and give us some suggestions, that would be great. Is there any parting comments you have? Maybe you want to throw something out there about Bitcoins or other fads that have been that we've been wrestling with.
One of the one of the keynote speakers at the conference is someone, Bob Shimon, who has written a book actually on Bitcoin. And he calls Bitcoin unlicensed gambling. Unlicensed gambling. I mean, I don't know what the value of Bitcoin is, right? I mean, when you make an investment, you want to know when to buy and when to sell. But Bitcoin, you don't know what the intrinsic value is, what price you're going to sell it. And I also know that prices always gravitate. In the short term, they can be really wild, but in the long run, they gravitate to intrinsic value. What's the intrinsic value of Bitcoin? Is it because somebody thinks it's valuable? It's valuable? I don't know. And I wrote about this, and Bitcoin violates, I guess, many things. It's not really money. It's not an asset. Has no inherent value, and is not correlated with the index, with any market, so you cannot use it as hedging. Now, also it's heavily regulated and will be more heavily. I saw actually this recently, or yesterday. It says that the Fed chair, Jerome Powell, said new forms of digital money, such as cryptocurrencies, present risks to the country's US financial system and will require new rules to protect consumers. So there's going to be a lot of regulation. Countries tend to be negative against Bitcoin. Maybe governments introducing their own cryptocurrencies will still outweigh the thunder from Bitcoin. And the only leftover business for them will be legal business, which the government will eventually regulate. And we saw actually, I think I saw some reports which said that many Russian oligarchs are evading now these things by going to Bitcoin.
Yeah.
So I think every generation must learn the hard way. It's now, I guess, the time of the millennials who love anything which is digital. And I think it's time to learn that if they pay for the fads, they're going to lose money. And, I saw also this the other day, that almost 50% of young people, 18 to 29,
yes,
they put their money in cryptocurrency, 50%.
I know.
So there's going to be a lot of poor little millennials when this thing blow up.
But the key is the key is knowing when to sell. And that's the hardest decision. And I think the reason why it becomes so difficult, as you pointed out, with the Bitcoin is because we don't have an intrinsic value. It's like, well, when should I sell?
When should I sell?
It's like until, someone it continues to be willing to pay me more for it, then why shouldn't I keep holding it? Anyway, I think, Professor, we could be on here for hours. I really highly value your time. Thank you. The timing, I think, is perfect for this. I'm going to be going to the conference in April 20th. I encourage you to guide those paying attention to to brush up on your value investing. Take a look at that conference, pick up the book, and keep up the good work, Professor. And we'll be definitely staying in touch.
Yeah, that would be my final, I guess, comment. Buy the book.
Or that's it.
Okay.
And pay attention to the details. That's why we're here. Thank you.
Bye-bye.
Bye-bye.